All right, everyone, welcome back to another weekly roundup episode of On the Margin. I am joined today by my new co-host, Maiden Voyage, with Mr. Mark Yusko. Mark, welcome.
All right. Well, thank you. Great to be here. I am actually really excited about this. It's almost like we get to rebirth Wall Street Week for the digital age.
Exactly. I think we'll be even better, honestly. I have faith in us. I think we can do. I think we can even one-up it. Now, Mark, I'm sure most folks on the show are going to be familiar with who you are, but do you want to just do a quick 30-second intro, what you're doing at Morgan Creek, all that kind of stuff?
Come on, Michael. You know I don't do short well. But all right, yeah. So Mark Yusko, I am the founder, CEO, and CIO of Morgan Creek Capital Management and also the managing partner of Morgan Creek Digital. That's our new entity that we formed back in 2017 to focus on digital assets, do venture capital, as well as manage some liquid protocols. So that's mostly it in a nutshell. I mean, Morgan Creek Capital has been around for coming up on 20 years. We focus on integrating alternative investments into traditional portfolios, and I came out of the endowment and foundation world as a CIO before that.
All right, amazing. Well, with that being said, let's just dive right into it here. Let's see if you can still look at charts and come up with some interesting analysis, which I'm sure you, I know you bring the mustard. So let me see if I can.
You know I have no strong opinions.
No strong opinions from you, Mark. Yeah, I know. We didn't put boxing gloves or anything on you when you spoke at DAS in that little thumbnail, which is still all-time video.
That's right.
All right, so with this first chart here, we're looking at U.S. total equity market cap to GDP. We're going all the way back to 1970 and looking at it to 2021. So obviously you got the nifty 50 back there all the way back in the day. And basically the point of this chart is just kind of measuring valuation of the stock market. So it looks rich here. But Mark, what do you think basically about where we are in the cycle?
We are in Stupidville in terms of valuation. And the problem is that markets can behave rationally longer than the rational investor can remain solvent, from Lord Keynes, and that's where we are. Look, I really didn't believe that we would go back to the craziness. I mean, 2000 was crazy. I mean, Cisco was selling at 286 times earnings, and think about that: to pay $286 for a dollar. That means you have to live about 104 years to make a 10% return. It's a long time, right?
Long time.
And that's just a 10% return. That's not even an above average return. So Cisco fell 84%. It's still not back to its previous high. Think about that. It's 21 years later, still not back to its previous high. So when things get to these levels, and now we're at a level even beyond that craziness, and everybody says, "Oh, but it's all justified by low interest rates." Well, okay, let's break that down for a second. Let's take that to the illogical extreme. If interest rates go to zero, which I actually think they will, are stocks worth infinity? Right?
Yeah,
anything divided by
question.
zero is infinity. So is that true? Well, no, of course it's not true. And in fact, low interest rates are a sign of economic weakness, not strength. So this is the all-time mania. It's the result of gamification of the markets. We got pajama traders, trading on margin and focusing on illiquid securities, and it's just one of these things that's compounded by money illusion. And that whole chart, if you look at it from left to right, and you smooth the trend, it is a perfect example of what's been going on in the United States since 1913, which is the destruction of the value of the dollar and the theft of wealth from the middle class and the poor to the rich. Yeah. And that's all this is. It's a straight transfer of wealth. It's straight kleptocracy. And it's sad. And no one really focuses on it. And I look at this chart and I say, hey, congratulations, America. We have turned into Venezuela. Venezuela has the best performing stock market the last 3 years. But did anyone want to own Venezuelan stocks? No. Because the Bolivar got absolutely trashed, and the dollar is being trashed right before our eyes. Housing prices down here in Chapel Hill, right? My daughter moved back here from Santa Monica. Her and her husband want to buy a house. House prices went up 18% last quarter in 3 months. That's insane, right? The houses didn't get better. They didn't grow. It's simply that the value of the currency that we denominate things in is getting less valuable. Now, the best thing about this chart is it makes the point so wonderfully, but let's think about this. If we didn't denominate that chart in a shitcoin, the US dollar, and we denominated it in real money, gold, it would be dead flat since 1996.
Yeah.
Just let that sink in for a second. The value of stocks denominated in gold is actually dead flat since 1996.
So let me ask you a question, because by the way, that housing example, so on last week's roundup, we actually we had two charts about home prices on there, and one was the amount of years that it took to pay for the median home price in America. From the mid-'70s, It's gone up from like 3 years to 6.5. But the real kicker is we tracked what the average age of a homeowner was from the 70s till now. And it's gone from something like 29 in the 70s to 47 today is the median age, which is insane. And even just since the great financial crisis, it's gone up by 8 years. But let me ask you this, because I love that intro, Mark, by the way. Yeah, no strong opinions from you. So let's take a look at this next chart here, which is we're looking at the share of global currency in the trade finance market. So trade finance, huge market, and this is basically just a kind of a good proxy for which currencies are being used in global trade. So we've got the US dollar in 2019, the US dollar in 2021. So for the last 2 years, I don't know the stats off the top of my head, but it's something like 36% of M2 for the US dollar has been created in the last 18 months. But here it's still being used as the primary denominator in the trade finance market. So how do you kind of rationalize these
here's
two
the thing.
thoughts?
So world reserve currencies are what they are, and they're determined historically by naval superiority. So back in the 1400s, it was Portugal because they had the tallest trees, and so they had the fastest ships. Then Spain took them over, and so they had the fastest ships. And then France took them over, and then the Netherlands, and then the UK got steam, and then we got nuclear power, and so we have superior navy. And China has been ascendant, so you can see China now in third place, and they have a goal, right? They want to be the world reserve currency. Now, whether they can achieve that goal remains to be seen. They are now a world reserve currency, right? They are in the SDR, so they are a currency that central banks around the world hold. And they are increasing the usage of the renminbi relative to other currencies around the world. Now, in the last couple of years, it has stalled, certainly. Part of that is just what's happened with global trade collapsing because of COVID. Global trade just fell off a cliff, and you can see it everywhere in supply chain problems. And try to buy a bicycle. I went to try to buy a bicycle, can't find them. Right? They just don't exist. Try to buy computer chips. I went to buy a computer printer for my wife the other day. The shelves were empty. So that's part of it. The second part of it is the dollar is the hegemonic currency around the world because we created it that way in 1971, right? We went off the gold standard, we cut a deal with Saudi, and we went on the oil standard. We created petrodollars. And we promised to protect the Saudis at all costs, no matter what, as long as they priced all currencies in dollars. And anyone who challenged that was immediately disposed of. Remember, Saddam Hussein said, nope, I'm going to price oil in euros. He disappeared. Gaddafi said, I'm going to price oil in gold. He disappeared. So you don't want to challenge the petrodollar authority because they disappear you. And so now what's going to happen, I believe, is China is going to create this digital renminbi. And that is going to achieve for the first time a shift. Because if you're in Venezuela over the last few years and Maduro was stealing all your money through cronyism and kleptocracy and devaluing the bolivar, your only choice was to turn your bolivars into something like Dash or Monero or Bitcoin before it went out of business. Well, if there is a digital currency that they can buy, and before there were digital assets, what did they do? They went out in the street and they tried to buy greenbacks. And the problem was some of them were real, some of them were fake, and it was a real problem. But they actually physically went out to find American dollars. Now they look at digital assets. Dash is going crazy down there. So I think it's interesting that the digital renminbi could change this chart. And I believe the dollar is on its way down. Now, the reason this chart hasn't changed that much in terms of relative is everybody is devaluing at the same time.
Yeah.
The
right.
Chinese, except the Chinese. The Americans are devaluing, the Europeans are devaluing, the Japanese are devaluing. Everybody is devaluing because that is the only way out. When an empire gets into debt, right? You have four options. I tweeted this out yesterday, right? You have four options.
I saw this tweet. Yeah, this was great.
Yeah. You can pay it back. You can restructure it. You can default on it, or you can devalue it away. Well, we can't pay it back, right? Even if you taxed everybody 100% of their income and their wealth, we couldn't pay back the debt, right? Here, Japan, Europe, can't do it. You could restructure it, but to restructure something, you got to have somebody take the other side. No one wants the other side. People aren't buying our bonds anymore. So who's buying them? The central banks, right? Which I think you might have a chart about. And then if you can't restructure it, then you got to default on it. Well, hell no, you're not going to default on it because then you get kicked out. And remember, politics, no left, no right, no Republicans, no Democrats. There's in and out. And when you're out, you do or say whatever it takes to get in. And when you're in, you do or say whatever it takes to stay in. And defaulting on debt would get you out, so you don't do it, so you stay in. So the only way out is to devalue your currency, and that is what we're doing. And the idea, you said it, 36, I think it's actually now 40% of U.S. dollars have been created in the last 18 months. We've been a republic since 1776. Okay, 40% of the dollars ever created in 18 months. That's insane. Think about it. If I have if I have a pile of $1 million here on my table, and I give you a pile of $1 million on your table, what happened to the value of those currencies? They just got cut in half. And every time you create money by fiat out of thin air, you destroy the purchasing power. And again, people have heard me talk about this before. Think about you. This doesn't work for you because you're young. I'm old. But I ask people my age.
Age is a number.
What's the lowest price you remember for gas? What do you remember? For gas, mine was 31 cents. My first car, I filled up for 31 cents a gallon. I just paid $4.31. It's the same gallon of gas. It does the same thing. It produces the same amount of heat, actually a little less because it's got ethanol in it. It didn't get better. The gas didn't get better. The money got worse. And that's what's happening. But China has a ways to go before they can claim superiority. But they have a plan, and they are playing a different game than the rest of us. Right? The rest of us are arguing about how to set up the checkerboard, put up sanctions and trade barriers. And they're just playing a different game. They are so far ahead of us, right? You think about this whole thing about, the Chinese market is uninvestable. Think about who lost all the money with these changes to the rules on Chinese stocks. Was it Chinese investors or American investors?
American
investors.
That's such a good point. I actually didn't end up pulling this as a story for this episode, but one thing that I would love to get your opinion on is if you just look at how the U.S. Is conducting regulation right now and all of the stuff that's going on over in China, I think it's really interesting to look at how these two governments are kind of dealing with similar problems, but their solutions are drastically different, right? In China, it's all about kind of control. There's this crackdown. They're trying to control commodity prices. They're releasing commodities from their strategic reserves to try to control that. They're trying to slash and lower the price of education. And in the U.S., I'm not 100% sure what our strategy is anymore, but it is just really interesting.
Michael, we would have to have a strategy. In order to understand what the strategy is, there would have to actually be a strategy. We don't have strategy. We have cronyism and kleptocracy. We have a system of government in the United States that is designed. And this is the thing. Everybody says, QE's not working. No, it's working perfectly. It's doing exactly what it was created to do. It is stealing wealth from the middle class and siphoning it up. China's doing the exact opposite. They're trying to push wealth down, right? They're stealing it. They're doing Robin Hood, right? They're stealing from the rich, the Jack Ma's, and look at what Alibaba just agreed to. Alibaba just agreed, I love this, this is total extortion. They just agreed to fund, which means pay into, not by their free will, but fund a big fund to create social welfare, to raise the living standards of the masses. Now, why are they doing that? Well, because if you have a system, which they had for a long time, where only a small number of people get rich, right? There are 80,000 senators in the party. And then above that, there was a really small Politburo. And if the system was designed for those people to get rich and everybody else to be poor, well, then when you transition from a manufacturing economy to a consumer economy, there's nobody to consume. So what you have to do is you have to take some of that wealth and you've got to push it back down so that the average person can consume. So they can buy an air conditioner and a bicycle and a motor scooter and an apartment. And they've taken 750 million people. Think about that. 2 times the population of the United States out of abject poverty and push them into the lower middle class. Now they want to push them up into the upper middle class. And the biggest consumer market in the world over the next 20, 30, 40 years is going to be China. And so we're fighting this war with policy, quote unquote. Idiocy is what I call it, if that's even a word. But we're using 1930s technology, kind of like the financial markets with the 40 Act. We're using 1930s technology, trade barriers, because we think it's about made in China. We think it's about them taking our jobs and selling us cheap goods. No. The future is about made for China. It's about making things in other places and selling them to this greatest consumer market in the world. And on the flip side, we're doing exactly the opposite. We are creating a system that siphons the money to the top and makes the rich richer. We have the highest wealth and income inequality in the history of mankind. But that's been the plan since 1913. From 1776 to 1913, a dollar, which was stolen from the Dutch, the Rothschilds, who have owned banking for 700 years, called dollar. So we had a dollar. And it had a couple up and down around 2 wars, but it was a dollar. And in 1913, John D. Rockefeller and J.P. Morgan, buddies, went to John D.'s dad, Amory Aldrich, and said, hey, let's create a central bank that will control everything and make us bankers, or banksters, as I like to call them, really, really rich. And that's what the central banks do. They make people at the top rich, which you actually have a slide for.
Yes. So you started I'm glad we're talking about this now. We bring it back to wealth inequality here a ton, a lot. I personally think, I love the way that you frame this in terms of how empires fall. They get in debt. The precursor to debt tends to be wealth inequality. And you can look at this in the Roman Empire. I'll send you this thing after, actually. It's this, some guy wrote his master's thesis on this, and I've referenced this and probably sent it to like 25 people. I've tried so hard to get in touch with this guy. He won't respond to my DMs. It's great. But you can literally look at early century Roman Empire, and it goes through the same thing. It's like wealth inequality, slowdown in the economy, money printing, administrative bureaucracy, complete, eradication of the empire. But this is a pretty interesting chart here. So CEO to worker compensation. So you can just see it's like absolutely nuts, right? CEO comp. And one pretty interesting thing to note on this chart. So when they're talking about realized and granted CEO compensation, this is including the way that most CEOs get compensated today, which is stock options. And CEO pay was actually a really big issue for the Clinton administration. And so they drafted this thing, which was basically any compensation salary over $1 million would not be tax deductible for that company. But they included a big loophole. That's only in salary. That does not include performance incentives. So basically what they told everyone was to pay themselves in stock, right? Probably well-intentioned, but there's a huge loophole. So now what do you have? You have not only CEOs paying themselves more than they ever have, but to your point about devaluation of the dollar, they've actually separated how the upper class, right, management, CEOs, fund managers, etc., pay themselves in equity because it's tax advantaged compared to everyone else, which earns money in dollars, is non-tax advantaged.
Worse.
Yeah.
And then the government passes laws that reduce the taxation on corporations as long as they agree to use the money that they save to buy back their stock, which the kleptocrats, people like Warren Buffett, own in their portfolio. I mean, I rail about this all the time. Apple had the same revenues last year as 2015. Right? No growth.
Really? Is that true? Really?
Yeah.
That's
but per share, it went up 20% because they reduced the share count. That's just financial engineering, and people don't back it out. I don't understand. We have this industry that is supposed to do analysis, right? They're called analysts on Wall Street, but they're not. They're just paid shills, and the highest payments, right? Take Tesla, right? there is not one piece of research written on Tesla that's worth anything because it's all paid for by the underwriting fees. And you can do a perfect correlation, a perfect linear correlation between the raw and how much they pay in underwriting for a debt issuance or a stock issuance. And it's the same. Analysts get fired if they say something negative about a company. So we've set up this system to enrich the rich. And this chart, it makes me angry because it is theft, right? I mean, it is complete and total theft. And nobody thinks about it that way. They're like, oh, well, these people are so smart. No, think about it. The typical hierarchical corporation was designed, right, during the industrial age to leverage the smartest person at the top. Now, it happened to be a white male, usually, but now that's changed a little bit. But at the beginning, it was all white males, old white males, pale, stale, and male. And everything. And so what did we have? We had a lot of worker bees at the bottom of that pyramid to move the products and ultimately the stuff at the top. And the smarter the CEO, the better the company. Well, that was in a centralized world, in an industrial world. As we've migrated from the analog age to the electronic age to now the digital age, and we've migrated from an industrial society to a consumer and services society where we don't make anything, right? We just entertain each other. Literally, I mean, America doesn't make anything. We make oil, right? So we're now a big producer of oil. So we didn't make it, right? The dinosaurs made it or whatever process makes it. And, we make a few cars when we can get the chips from China, South Korea, but we don't make anything. So what do? We entertain each other, right? This is a crazy one. I have a 10-year-old. I have the funny family with the older kids and then the caboose. And my 10-year-old is part of this cohort where they surveyed him and said, well, what do you want to be when you grow up? 36% said they want to be a YouTube influencer.
I know.
What? Not
it's
a
what
fireman,
they see.
a doctor.
Yeah.
At least for me, I have this funny thing. So my son, I have two older kids. My wife was staying home with them, and then she had a job when the caboose came along 20 years later. And so we got a babysitter, and the babysitter spoke solamente español to Will since he's been 5 weeks old. So he's bilingual. I'm not. And so to help him with his homework, I use Google Translate. So I'll talk into the phone and I'll say, hey, Will, we had pork chops and applesauce for dinner. And Google Translate will tell it. And I'll say, how do you say that? And he'll say it. So I was talking to the phone and I said, when I grew up, I want to be a fireman. And he says, no, Dad, when I grew up, I want your job. I want to be head of Morgan Creek. I'm like, okay, all right. So what we try to do is we try to buy things before other people realize they want to buy them. All right. So what would you buy? Without missing a beat, he says, computers with holograms. I'm like, I'm done. I'm retired. You're the CEO. So I now work for Will Yusko.
Mark, I have a question for you. Does your son play Roblox? Does he know that game or like it? Have you heard that before?
He knows it. He doesn't play Roblox as much as Minecraft. He and his buddies are big into Minecraft, and actually, my son is still big on Nintendo Switch, so he plays a lot of Mario and those things. But he's not as big into Roblox as his son, but Roblox is amazing.
The reason I ask is, honestly, someone should make like an index of stuff that kids are obsessed with, and I would buy that every time. I tell the story all the time. My dad absolutely hates it, so Dad, I'm sorry if you're listening. My dad, when I was in 6th grade, he was like, I want you to get into investing, so I want you to pick a stock, and I'm going to buy some of that stock for you. So I was 12. This was like, 15 years ago. The stock that I picked was Apple 15 years ago.
Love it.
And but my dad, this was pre every stock split. It was like $18. Yep. My dad was like, this is overvalued. So he told me that he bought Apple.
Absolutely.
But he bought Polymer Tech something or other, which went up like 30%. And he didn't buy it.
No, he didn't buy your stock. Oh, that's
didn't buy my stock.
crazy.
And then what's funny? He asked my sister, who's 2 years younger than I am. He was like, I want you to pick a stock as well. I'll buy it for you. You know what the stock she picked? Google. Also thought that was overvalued. Didn't buy it.
Wow.
I'm sorry, Dad. You've done a lot for me, but I still think the story is so funny. Yeah.
No, it's awesome. And what it goes to is that anything that people use is going to, be valuable. And asking somebody what they actually use is a pretty good way to make money. In fact, one of my favorite stories about Apple, now I have a new favorite one. I love this one. But there was a hedge fund manager who, back in the day, when you could still do this, he hired college kids to go into the Apple stores and ask the clerks how many iPods they were selling, back when it was the little, square thing.
That's
and
amazing.
he was the first one who knew they were going to sell 1 million iPods in a year. And the stock was like, $3 or something. And everybody's like, oh, it's overvalued. And they're never going to hit these targets. And I think the street was like at 300,000. He's like, no, they're going to do 1 million. And I actually challenged him. I said, no, come on, Brett. There's no way you walk in and the guy's going to tell you. He says, are you kidding, Mark? You ask somebody making minimum wage what they think. They'll pull out the books, the records. They'll show you everything. He said, we had perfect information. I'm like, oh, my God,
That is
that's
incredible.
awesome. And then,
That is such a
and then
good
they made
story.
that illegal. Right? They said that's illegal. I'm like, why is that illegal? That's just intelligent. That's just smart. That's just hard work. That's
Yeah.
like, sitting on the side of the road counting cars that go into the mall. Why is that wrong? Now
Yeah.
there's satellites to do that.
I was
But-
just saying, now they use the satellites
was
for the
just-
parking lots.
yeah, it's just amazing insight, and he executed on it. And so I think in general, what this points to is as we migrate into new systems, all the good stuff starts at the fringe. I talk about this. I've made my whole career, right, about hanging out with the bad guys
Yes.
and gals, right? But the bad. So in the early days when I first joined Notre Dame, right, we had just had this big recession in the early 90s, and we went to the board and said, we want to buy junk bonds because they were really, really cheap. And they're like, no, Ivan Boesky is a bad guy. Michael Milken's a bad guy. I'm like, I don't want to buy them. I want to buy their innovation, which has created incredible wealth by making financing available to small companies for the first time. It had been hoarded by the big companies and the big banks, and this was an amazing innovation. And then we invested in the internet, right? And it was going to rot your brain, so to speak, and it was going to be no more important than a fax machine, according to Krugman. And to your Google point, right? I've told the story hundreds of times that we put $500K through Sequoia into Google and turned it into $200 million. There should be a quad at Notre Dame called the Google Quad. And that was my first aha moment that infrastructure mattered. And it's why I'm doing what I do, right? 8 years ago, I spent 0 time in digital assets. I got introduced to Bitcoin the same time as the Winklevoss twins. They're multi-billionaires. I'm not because I'm an idiot. And Dan Morehead gave it to me on a silver platter, and I just didn't get it. I wasn't running drugs on Silk Road. I was not a cryptography student. I didn't get it. And more importantly, I didn't do the work. It took me the next 3 years to do the work. And then I kind of went all in 17, 18, which was still fine and early. Wasn't as early as I should have been. And now I'm spending all my time doing this. I mean, all of it. And I love it. And it is so fun because the bad guys and gals do the cool stuff like Roblox or the one that's killing me. Oh, this is killing me. So during lockdown, my then 9-year-old introduced me to Pokemon Go. And we went out and did Pokemon Go together, and we've been and now I like it more than he does. I mean, I'm totally addicted to it. But the crazy thing is there is a decentralized version of it called Axie Infinity that I could have done.
I know.
And it's killing me. And here's the crazy thing. Axie Infinity did more revenue than Fortnite in the last 12 months.
Yeah.
That's unbelievable. It's awesome. It's unbelievable.
Well, so these next couple slides kind of feeds into this whole CEO to worker. So you can look at this and just say, look, this is completely nuts at this point, the divide that has come between the elite versus, kind of everyone else. So I'm not sure if you've noticed this, but the labor shortages are pretty crazy right now. And these started cropping up back, a couple months ago. And in the beginning, it was like, oh, you can't find, minimum wage people to, take care of your country clubs. Like, why don't you just pay them more? So this is just completely anecdotal. It's never good to totally go off anecdotal stuff. But in New York, so I live in Williamsburg, and virtually every restaurant that I go to now, it's printed right there on the menus, like help wanted, bear with us, we can't find workers. There are surcharges now being applied. They're like, hey, if you want to contribute an extra 5% on top of the tax. So it's just pretty crazy. Now, we'll get into these reasons, but I will say as well, and what people blame, people blame the benefits that the government is giving. This is a pretty interesting chart because it literally just shows you change in non-farm payrolls April to July. It's not different between states that prematurely cut the benefits and maintain the benefits. So that's not the reason. And if you look at this particular chart here, which was produced by BCA Research, it actually looks like people have a financial cushion, right? So my interpretation of everything that we're just talking about, people are kind of looking around and saying, this is nuts. I am just not getting compensated for the work that I'm doing. I'm watching everyone else get stupid rich. I finally have some money. So I'm not gonna rush back into the workforce. And I think you're starting to see companies freak out. The labor market is extremely tight right now. So I'm curious,
in certain areas, the labor market's definitely tight. I mean, it's definitely tight in the lower wage service industries, and the nature of that is, look, we did a whole bunch of things wrong, right? We got tough on immigration, yet we're a country of immigrants, and
that's just,
you think about it, the average person who's willing to do low wage work is not going to be a highly educated college grad, from a urban suburb, right? It's going to be somebody who came here with nothing and works their butt off, and not just immigrants, but it's just, there's an entitlement problem, right? We have this trophy, a participation trophy world in which we live, and I hate it. I mean, I can't stand it. I tell a story all the time about, my son, when he was 4, he went to the first soccer team. They went 0 for 10. 0 for 10. And they gave him a medal. And I took the medal and I threw it in the trash. And everyone was horrified. And I'm like, no, you don't get a medal for going 0 for, right? You have to win. You have to aspire. You have to do something. And remember, part of kleptocracy and part of empires and part of cronyism is designed around impoverishing the masses. Well, how do you impoverish the masses? Well, you make them dependent on government handouts. Okay, so you give them free stuff,
bread and circuses,
and you discourage them from being productive members of society. And look, Jimmy Song talks about this. I love Jimmy, and I wish I could look like Jimmy with the hat and so cool. But he talks about this all the time, that if you have a salary, and this is a toxically charged word, right? You're a slave. It's just a fact. And you're a slave to an asset that can be taken from you through inflation. Inflation is the biggest craziness perpetrated on the American people, actually all people, ever. Right? This idea that inflation is good for you, that prices should go up. No, they should not. Right? The way things should go up in value is if you create new things, if you build new things, not by decree of devaluation of the currency. That's all inflation is. It's just a fancy word for currency devaluation. And so we've set up this world in which people believe they're entitled, right? They should sit at home and get free money from the government and day trade on GameStop. And that's okay. It's not okay, right? You're not contributing to society. You're not doing anything. And the extended unemployment benefits, it's definitely true that if you give people unemployment benefits, they will not look for jobs, right? Now, if you take them away, they will go look for jobs. Now, some of them won't, to your point, because they're still, they've made some money in, trading or they got a gig economy thing that they don't report. And look, work from anywhere helps too. I do think that the movement to digitization everywhere, not just digital markets and digital assets, but digital world is a really good thing. And, we can do this from anywhere. Right? Yep. We can talk to each other. We can I don't have to travel as much, which is bad for certain companies like American Airlines, which I used to spend a lot of money. I mean, like a lot of money on American Airlines. I haven't gotten on an airplane in a long time. So yet I'm equally productive because of technology.
Howdy, everyone. If you're a long-term investor in Ethereum, then listen up because I am talking directly to you here. If you've been listening to the show for the last 2 months, then you know that I am a big, big fan of ETH and the entire world of DeFi that's being built on top of it. It's honestly just super, super interesting, but it's also probably the single greatest wealth creation opportunity that I am ever going to see in my entire life. And the best thing about ETH is that you can hold it, but with this new upgrade to 2.0, you can also stake it and earn yield that way. The only problem is, under the current set of rules, a unless you have 32 ETH, or at today's price is almost $100,000, then you can't stake it. Until now. Our good friends over at Matrixport just unrolled a solution which allows investors with as few as 5 ETH to start staking today. At the time of this recording, you can earn up to 9% APY, although that's going to vary based on the protocol. So, stop what you're doing, stop listening to me, go click the link at the bottom of this episode. If it's on YouTube or Spotify or Apple or whatever it is, click that link, go over to the website, and tell them that I sent you. All right, give me a little credit, but definitely go click the link, start learning about how you can stake your ETH and earn yield or other yield generation opportunities. I want to make sure we move on to cover some of these stories that we've outlined. So it's been a pretty interesting story week. And just to give everyone a headline of what we're going to cover here. So John Paulson, a very famous hedge fund manager, called cryptocurrencies a worthless bubble. So I want to get into that. Gary Gensler signaled that a ban for payment for order flow might be on the table. But honestly, Mark, what I'd really love your opinion on is just like what he's, because I kind of hear whispers, every now and again, and it really does seem like the SEC is starting to wake up and pay attention to crypto in a pretty big way.
Yep.
And then I really would like to talk about the crypto exchange FTX. They're acquiring LedgerX, which is a pretty interesting move because they're paves the way into the derivatives market into the U.S. So I should say this is FTX US purchasing. It's their operating subsidiary in the US. And just the dynamic of, because exchanges at one point had this big decision to make, like, do we try to be the regulated exchange or do we just go as big as possible, get volume, and then kind of move in that way? Yeah. So let's start with this story about Paulson. I'll kind of give the background here and then kind of tee it up for you. So basically, it's a Bloomberg article that came a little while ago. Blockworks reported on it too. But ever since John Paulson bet against the U.S. housing market more than a decade ago, he's been looking for kind of his next big trade. And when we say big trade, that one trade netted John Paulson and his investors $20 billion, right? So this guy he had a career before this, but this is how he really made his name as kind of a legend. I will say, not to take anything away from the guy, his investment returns after that have not been super stellar, right? So he was doing an interview, I think it was with David Rubenstein, and it basically is looking at a bunch of areas of the market that look pretty frothy. So he kind of put SPACs, meme stocks, and eventually in cryptocurrencies in the same sort of bucket. And he said that eventually they'll prove to be worthless. So, Mark, what's your take on kind of Paulson's saying this?
It's so hard for me because, look, I mean, John, in many ways, is part of the reason that I'm sitting here. Mm-hmm. Part of the reason Morgan Creek became anything is when I left the university, when I was working at University of North Carolina, and I decided to leave and start my own firm. And you start your own firm, it's scary, and you might not be successful, and
right.
And you're taking risk. And I got an email, and it said, "Say it ain't so, Julian." And I joked, I don't get a lot of emails from billionaires. In fact, that was my very first one. And I thought Julian Robertson, famous from Tiger, was going to try to talk me into staying. And I thought I was going to get my Nike shoe deal, right? Mm. So the coach at North Carolina makes $200,000. Not very much. He makes $4 million. Well, how does he do that? Well, he has a Nike shoe deal, and he got radio and television. And so, I was making $150,000 at the time, and so they don't pay you a lot to work at a university. But I loved my job. I mean, I loved every day of my job. I got the psychic income from helping the students and the faculty. And I thought he was going to try to talk me into staying. So I got on a plane, came up to New York, and I go to his office, and he comes out, he puts his arm around me and says, "Mark, I'm surprised you lasted this long. I like you, and I want to work together." Like, I will hit that bid. It was like one of the greatest days of my life. And he gave me some working capital to start Morgan Creek. Mm-hmm. And so one of the things he tells people when they would leave Tiger, right, whether it was Lee Ainsley or John Griffin or Steve Mandel or Chase Coleman, they say, "Do you have any advice?" And he'd say, "Yeah, make sure in the first 2 years you get lucky." Like, well, that's really good advice, hard to follow. So, we launched in 2004, and we launched a couple products in 2005, and we started off and we went from 2 families to 10, and then it went dead flat. And I'm like, oh, okay. And another year went by, and we were still dead flat. I was like, oh, geez, what have I done? I took all this risk, and we're not growing, and then we got lucky. And I had met John, and John was a great, and still is a great merger arbitrageur, one of the best ever. But merger arbitrage was kind of going down because technology was giving everybody the spreads versus the old days where one firm had a better model. Make a long story short, he had come up with this idea on subprime. Now, whether he did it or one of his guys or whether he took it from the dentist in California, doesn't really matter. But John was one.
He did it.
And I went all in, right? I put money with 5 different people: John Paulson, John Burbank, Kyle Bass, a couple other guys in New York, and we put 10% of client assets short subprime, and we made a ton of money for our clients, and that's why we became kind of not famous like him, but that's how we went from a couple $1 billion to many billions of dollars, and we had a really good run, and that was my luck. I got lucky to meet him, and now I had to actually agree with him, and I had to put the money in, so it wasn't just all luck. There was a little bit of effort, but so I owe John a lot, and I've been friends with John for years now, and I have nothing but respect. To your point, subsequently, he's had his trials, but here's the thing. I said, with all that said, and I have nothing but respect and admiration and love, actually, for John, I just think he's dead wrong. I think he's just completely wrong. And I think he's where the average smart person is about digital assets. They haven't done the work. And so everyone I know and admire and respect in this space started skeptical, including myself, right? I missed it in 2013. I mean, Dan Morehead laid it out on a silver platter. He said, here's Bitcoin, here's picks and shovels. I'm like, oh, I don't get Bitcoin, but picks and shovels, I get those. I'll invest in those. It's been great. And we're early investors in a lot of things like Coinbase and BlockFi and a whole bunch of other things, and it's been awesome. But if you don't do the work, you will remain skeptical because people are going to spread FUD, fear, uncertainty, and doubt. And if you listen to the media, and more importantly, if you listen to the incumbents, and this will weave into the next story about regulation in the SEC, incumbents will always use fear and regulatory hurdles to stop innovation and disruption because people don't like to be disrupted. Mm-hmm. Right? If you ask the average person, why are stoops in downtown New York 9 feet above street level? Right? There are these old homes, these old brownstones, and the stoop to the house is 9 feet above street level. I'm like, well, why is that? Well, it's because of horse shit. Like literally, they'd sweep the horse poop to the side of the street and it would pile up 4 or 5 feet tall. And the ladies didn't like walking in it, so they built elevated sidewalks 9 feet high, and the stoop of the house was on that elevated sidewalk. Now, the problem is if you got drunk late at night and you fell off the sidewalk into the poop, it was bad. But that's why that existed. And the street sweepers, when the horseless carriage came out, passed out pamphlets saying you die if you got in a horseless carriage. Fear, uncertainty, and doubt. And so then they tried to pass regulations saying, oh, well, you can't bring horseless carriages into the city because we got to protect the workers because they didn't want to lose their jobs. We have more jobs today than we've ever had in the history of mankind. We've lost more jobs than the history. So that's the way it works, right? We lose old jobs and we build new jobs. And it's those people working on the fringes to build new ideas and build new businesses that create the new jobs, right? How many people work for Amazon? Amazon didn't exist 24 years ago, right? And that's the way the world works. Innovation is good, disruption is good. And so John is, I think, unfortunately wrong. He's made a big bet on gold, and it worked really well back in 2009, 2010, up through 2011. And it's just been a shit show since. I shouldn't swear so much, but it's been a bad investment since 2011. And we got the Peter Schiff war, and he keeps clinging to it. And the reality is that it's going down in a world where the amount of money is going up. That's illogical because gold, historically, for 5,000 years, was the only money in the world. Yeah. Money is an asset that exists in the absence of a liability. Everything else is currency. Currency is different. Currency is associated with a liability, government debt. Right. So currencies, the reason they devalue over time is the government debt gets too high. Money, gold, doesn't have a liability. So it stores value. It keeps its value. What Bitcoin has become, it's not what it was envisioned to be, what it has become is digital gold. And it's a beautiful store of value. And I think it will, for hundreds of years, be a perfect store of value because it's more scarce now than gold. So John made a bet on gold. It hasn't really worked out. and he and Schiff and others won't change their mind. And I think that's maybe the most dangerous thing in investing. Right?
Yeah.
I told you at the beginning, I don't have any strong opinions. Ha ha ha. I have lots of strong opinions. And people go through my Twitter feed all the time and like, oh, you said this 4 years ago and you were wrong. I'm like, dude, I've changed my mind 17 times since then.
Yeah.
I change my mind all the time. If you don't have conviction, you won't act. If you don't do the work, you won't get conviction. If you don't dive deep, you won't do the work, you won't get conviction, you won't act. And so that's how great investors do it. If John and his team had just said, oh, I think subprime's interesting, but they hadn't done the work, if they hadn't gone line by line, zip code by zip code, and seen the actual data on, same thing as Michael Burry, they wouldn't have done it. But they did. And for some reason, he and others, people I admire and respect, aren't doing the work on Bitcoin or Ethereum. If you do the work on digital assets, you cannot, and this is a strong statement, you cannot not be excited if you do the work.
Can I offer an alternative explanation here? See what you think. I'm so glad we started with this because
Sure.
I didn't know that you had that relationship with John. I was literally like, Mark might actually know John, so I'm really glad that I did this. But here's my thought. So I had the same connection in between Michael Burry and John Paulson. And someone told me this about Nouriel Roubini a little while ago. I can't remember. It was someone who worked with him. He's like, look, he's a really nice guy. He made his career by calling the 2007-2008 bubble. And what happens when you make your career and you build your brand around a certain thing is that's what you want to continue to do, basically. So the connection between John Paulson and Michael Burry, they were, successful guys before this, but they really made their careers on calling a big bubble. So what do you want to do later? You want to continue to build on that brand and that reputation. So you want to call the next bubble. So it's almost like, crypto is basically one big exercise in bias and psychology. And nobody's biased. If you're long, you're biased. If you're short, you're biased. If you don't know anything, you're biased in one specific way or another. So it's just an interesting,
No, I think it's absolutely true. I think there's one subtle difference between John and Michael. Mm-hmm. Michael is really not a bubble caller. Michael's an amazing analyst. Like the reason he found subprime was not because he thought there was this big bubble in housing. He just looked at the underlying data in the CDO squared and all of the alphabet soup. And he's like, these mortgages are worthless.
Yeah.
Like this tranche of risk is worthless. And I want to be short worthless. And so the same thing is, it's the reason he got short Bitcoin earlier this year in March, April, is he looked at the leverage coming out of China and said, that's fake, right? That increase in price in January, February, March that was driven by speculative fever and high levels of margin debt had to reverse at some point, right? You can't lever 100 to 1 in an 80 vol asset and expect to win long term. You can win in the short term, but you can't win long term. And so I think that Michael's not quite as wed to his bubble picking as John, as Jeremy Grantham, and as others. But that's just an opinion.
Yeah, absolutely. But speaking of, so what you were kind of getting into there with the leverage and some of the regulatory oversight, I do want to start talking about Gary Gensler. Now, the reason I included this in this week's roundup is because there is the payment for order flow thing. That is interesting. That's been on the hot seat, but basically you go back to May 6th.
Yep.
So that's the first time that Gensler got up in front of Congress. That's when he kind of dubbed himself like the new cop on the beat. And he pointed to a couple things in particular. So he pointed out meme stocks as something that he didn't like and was looking into.
Yep.
The Archegos blow up. So just where leverage sits in the system and kind of reporting and stuff that has to happen. And then he said that crypto merited a deep look. And the interesting thing about Gensler is that he taught a class on this. He is not he deeply understands the space, I think. So like the least charitable way to look at this is that, oh man, you actually have a regulator who knows their stuff. That could be way more dangerous than someone who doesn't know their stuff. A more charitable way of looking at it is saying, this is a guy who gets it. He understands both sides of the aisle, so to speak. He knows that this isn't going to continue to be non-regulated for a long period of time. He also gets how to probably do it in the best ways and maybe push back on some areas that, should be pushed back on. So what's your interpretation? And I'm starting to hear from like a lot of funds and projects that I talk to that it's like, we are getting a lot more calls from the SEC and different regulatory departments and stuff like that. So what's your kind of thought on Gensler and kind of this recent push in regulation?
You know, I look, first off, I actually admire how the SEC has approached crypto over the past decade. Right? They've been measured, they've been prudent, and they've been consistent. That is not their long-term history, by the way. So I have to give them credit where credit is due. The one problem I see is the chair of any government position, I think, changes people. Right? I think people can be who they are outside the world, but when they take a particular chair, whether it's the president, vice president, Congress, senator, or head of a bureau like the SEC, I think the chair does weird things to people. And I agree. I think Gensler is very smart. But I think, unfortunately, everything that he outlined is like he literally talked to the press secretary and said, okay, what do you want me to talk about? Okay, these are the 3 things that are hot in the press. Okay, I'll cool them down. It's like jawboning. It's like when the Fed says, oh, we're going to taper. How'd you guys take that? Oh, okay, you didn't like that. Okay, well, we might taper. You didn't like that either. Okay, we're definitely not going to taper for now. So how many times have we talked about tapering since 2013? 100. How many times have we tapered? 0. We're not going to taper. Right? You can talk about all you want. But if you take the punch bowl away, then assets are going to fall and the rich people are going to scream. And so the chair has this impact on people. And I think, unfortunately, there are things that become hot topics because they either don't seem fair or they seem rigged.
Yeah.
Payment for order flow has been going on forever. It just wasn't as big a deal. And if you want to if you want to bust on it, fine. But, you could have busted on it 20 years ago or 30 years ago or 40 years ago too. On the crypto regulatory side, this goes to incumbency. Incumbents, particularly the banks, really, really don't like where this is headed, right? Because in a trustless society, I don't need third-party trust agents. So I want to send you $1. I need a bank account. You need a bank account. We pay a wire fee. I want to send you a Bitcoin. We don't need the banks anymore. So I believe that there is pressure, shockingly, to certain bureaus to regulate against things that hurt very wealthy people. Let's take the XL pipeline. XL pipeline should have improved a long time ago. We need the XL pipeline. It's way safer to transport oil and gas through pipelines than it is through tanker cars on trains. Mm-hmm. Oh, but Warren Buffett owns a bunch of tanker cars, and he really likes making money sending that oil down through the middle of the country. So guess what? As soon as the side that he supports with his big fat paycheck gets in charge, they reverse the decision to approve the XL pipeline. That's the way government works. It's pay to play. And I think there are big, meaningful incumbents paying big money to raise the regulatory hurdles.
Yeah.
But they will fail. They failed throughout history. They will always fail. Innovation wins. Innovation wins. And decentralized protocols will dominate financial services. They will.
Yeah.
And there's no way to stop it. You can delay it, and you can make life miserable for the people on the front lines, right? Remember that it's the first person, the scout, right, takes all the arrows. And so the people who come after look like heroes, but it was really those scouts that went out and took the first arrows.
Yeah. And, as we're talking about this news just broke like an hour or two ago, but Compound Labs, which is not the decentralized protocol itself, but the kind of company that contributes to a lot of the development there, they are apparently getting investigated or something by the SEC. I haven't had time to look into it, but it is worth noting. Yeah. This is probably, I totally agree with you. This is going to happen. This is first they ignore you, then they laugh at you, then they fight you, then you win. And at a certain point, here's something I've
think about Ant Financial.
Yeah.
Why did Ant Financial get in trouble, right? Ant Financial got in trouble because Alibaba set up a money market that you would use through your Alipay system. And it siphoned in 9 months $90 billion out of the banks into this fund. It took the top two money markets 100 years to get to $90 billion. Fidelity and Vanguard. It took them 100 years.
Yeah.
Okay. These guys did it in 9 months. And so what happened is the government, the PBOC said, whoa. You take our deposits, our banking system fails. So no. You're not going to do that. Same thing's happening here. Why compound? Because deposits are at the root of the banking system. Stable coins. Why are they talking about stable coins? Because they're at the root of the SWIFT system. Now, look, we're going to have Compound. We're going to have Aave. We're going to have all of these protocols are going to win, but they're going to have to fight really hard in the short term to get through this retrenchment by the incumbents. And what will happen in some cases is the incumbents will just buy them. That's what Cisco used to do, right? Cisco fought for years to not be irrelevant by just buying technology and shelving it. But it's like most people don't know that the biggest car company in America in 1908 was the American Electric Car Company.
I did not know that.
Think about that for a second. Cars ran on electricity. In the basement of the Dartmouth Engineering School, there's an electric car that went 46 miles per charge from 1910. And then what happened? GM said, well, we like selling gasoline cars because we have this deal with John D. Rockefeller and Standard Oil to use gasoline. And so we're going to buy that technology and we're going to shelve it. And so electric car technology was shelved until, Elon and those guys came along. Actually, it was Fisker first and then Elon. But anyway, so yeah, I think Gensler is probably less like with Clayton, you knew where you stood. You knew he just wasn't going to do anything in terms of he wasn't going to approve ETF. He wasn't going to attack either. So there was this kind of nice environment where they made a decision on Bitcoin. They made a decision on Ethereum. They said the ICOs were securities, which they were. And you kind of knew where you stood. Now, my feeling is we got a guy in a chair. And I don't think it's the guy. I think it's the chair. I think the chair is now getting money poured on it. And we're going to see some fight that in the short run will be painful, but in the long run will set the stage for the transition to the decentralized finance world.
Yeah, I completely agree. And I know we're running low on time here, so I don't think we're going to get to this FTX.
I told you I don't do short well, but let's do the last one really fast.
Okay, cool. So just on that same theme of regulation, right? So the big question, right, has been these offshore, semi-regulated, let's call it, exchanges, right? The Binances of the world, the FTXs of the world. If you rewind to 2017, there's a lot of attention being paid to FTX. If you rewind that to 2017, 2018, you remember Binance? They were this unstoppable execution machine. It was like anything they did, they rolled it out, they crushed it, and they still, like the volume on Binance, like dwarfs anything else. It's not even close.
Anything else? Not even close.
Couple what is it, a month ago maybe is like that 100x leverage or 125x leverage they're really famous for, that gets ratcheted down in the US. Binance, you see turnover, you see Catherine Coley go to Brian Brooks has just left as well. I honestly don't know the inside story there, if that was him leaving or if he got forced out, and now it looks like they're being investigated, and FTX US, the operate, bought LedgerX, which is a very compliant derivatives exchange. They were early to the game. It's just really interesting. I think there's starting to be shakeups in that space, and I think the two stories.
If you don't do it the right way, you're done.
You're done,
right? Because look, and the one thing I loved, I did like Jay Clayton said this at, I think it was at your event. Maybe it wasn't your event. Anyway, I thought it was your event, but
one other
he
super
said
high quality event. Yeah, just like we do.
Some, yeah, exactly. Some super high quality. He said, "Hey, wait a second. We've built a pretty nice financial system using our regulatory framework. It's generated a lot of wealth for a lot of people." I'm like, you know what? That's damn straight. That is exactly right. So yeah, let's not trash the whole thing, right? We don't need unregulated. What we need is for people to be thoughtful about how we interact in a regulatory framework. And so I do think that being regulatorily compliant makes sense. Now, the one caveat, though, is we got to get away from American exceptionalism. And it's hard when we live in the American empire But American exceptionalism says, oh, well, we're the center of the universe. No, we're not. We're like sub 20% of global crypto. And crypto lives in a global, borderless, non-nation state. And so the idea of nation states becomes curious. And so, China bans exchanges. And what do? They move to Japan and South Korea. They ban mining. And what do? They move to US and Canada and Europe. So you can't ban it. And you can't really over-regulate it because then people just leave. And so I think you have to have a symbiotic relationship between regulators and innovators, which is hard because the incumbents don't want that. But hopefully what will happen is some of the incumbents will pick up some of the innovation, bring it in, and they will innovate iteratively with this compliance and this regulatory mindset. And so I'm actually pretty hopeful about it.
Me too.
And excited. And I love that we can keep talking about this, and we will get to talk about this on many, many Fridays. So
many more shows. Absolutely. All right, Mark, this has been a great kickoff show. I'm excited. I know we went a little over time, but this was a lot of fun for me. So I will see you back here next week.